In the last video, we talked about adding Bitcoin to our S&P 500 portfolio. Now, let us talk about adding another cryptocurrency to that portfolio. But before that, a disclaimer. This is not investment advice and we are not giving any investment recommendations. Our analysis currency is USD and the analysis period is 1 year period between 12th November 2020 to 12th November 2021. In the last video, we saw that optimal allocation of Bitcoin to S&P 500 is 5% for a 30-day holding period and around 2% for a 365-day holding period. Now, let us add another cryptocurrency to that portfolio. So for this analysis, we are considering Dogecoin. Why Dogecoin? Dogecoin is probably the most hyped up cryptocurrency this year. One of the reasons being Elon Musk. And the price of Dogecoin is up around 5,500% from the beginning of 2021, even after the crash in May. So is Dogecoin a long-term potential investment? And how much Dogecoin we can add to our portfolio of S&P 500 and BTC? Now, before we move to the optimal portfolio, let us look into the correlation between these three assets. So we have created correlation matrix for rolling 30-day returns and rolling 365-day returns. I want to point out here that if we consider the 30-day holding period, these three assets are not really correlated. But if we consider the 365-day returns, S&P 500 and BTC are kind of correlated, but both S&P 500 and BTC are not at all correlated with Dogecoin. So Dogecoin can act as a hedge as it appears from here. Now let us talk about the average rolling 30-day returns of these three assets. We can see that S&P 500 is around 2% compared to around 17% of BTC and more than 100% of Dogecoin. That is 100%, more than 100% month-on-month growth. But at the same time, the volatility of Dogecoin is much higher than BTC. So if we calculate the Sharpe ratio, we can see that actually S&P 500 Sharpe ratio is better than both BTC and Dogecoin. Now let us consider the 365-day rolling returns, rolling 365-day returns. S&P 500 is obviously negligible compared to BTC and Dogecoin, same with volatility. But if we consider the Sharpe ratio, if we calculate the Sharpe ratio, we can see that the S&P 500 Sharpe ratio is slightly higher than BTC Sharpe ratio and around double that of Dogecoin. So what is the optimal portfolio of S&P 500, BTC and Dogecoin? My model gives me for 30-day returns, the optimal portfolio is around 4.2% of BTC to S&P 500 and less than 1% of Dogecoin. And if we consider the 365-day returns, it's practically no Dogecoin and around 3% of BTC. So what can we conclude from here? The model is practically saying that you should not add Dogecoin to your portfolio. Does that mean that you cannot profit from Dogecoin? Not really. The model is saying that Dogecoin is not something you hold. That doesn't mean that you cannot speculate on Dogecoin, but limit the speculation up to maximum of 1% of your portfolio to avoid sleepless nights. Thank you very much for watching. Bye-bye.